What is the biggest expense that most people will pay? Is it your mortgage? Is it your rent? Nope, it's taxes. But what if I told you, as a doctor or busy professional who's taxed to the max, that there's another way? That there is a way to save on taxes by investing in multifamily real estate. Today, I'm joined by TJ Caleca, who's the president and founder of ProudLiving, which is a vertically integrated real estate company of over 2,000 units. TJ Caleca, welcome to the show.
Thank you for having me, buddy.
Welcome back to the channel. I'm Jonny Walker. I'm a self-made multimillionaire in real estate investing, as well as an endodontist. Investing heavily in real estate over the last 13 years has allowed me to take a giant step back from my clinical practice, spend enormous amounts of time with my friends and family, take 6 to 8 vacations per year, as well as work on my passions, which is investing in real estate and helping my fellow doctors and dentists on how they too can achieve financial freedom through real estate investing. We are going to discuss 4 of the best techniques to save money in taxes, and this might have you feeling a lot more empowered by the end of it. So let's get started. TJ, tell me, I want to talk about 4 different techniques. You told me about 4 different techniques before this show that I would like you to go into it. Number 1, cost segregation. What does that mean, and what is the benefit of that for a real estate investor?
Sure. So cost segregation is depreciation on steroids. So there's a number of different strategies that you can do that are a bit more advanced than regular automatic depreciation. Okay, they're accelerated depreciation, cost segregation, bonus depreciation, but those are a little complicated, and anybody, can obviously just reach out to their CPA. But let's just talk about the automatic basic depreciation and how that works. So a piece of residential real estate, multifamily real estate, is depreciated roughly over 27 years in equal parts. That means if you were to purchase a property for $270,000, $10,000 a year is going to be depreciated per year for 27 years. That means you are going to lose $10,000 a year on paper due to basic depreciation, which is automatically done on an annual basis for 27 years from the time that you buy an asset. So you buy a property for $270,000. That property brings you in cash flow of $10,000 a year. Your basic automatic depreciation of $10,000 a year wipes out your $10,000 a year of cash flow. You have a net zero income, you pay 0 taxes. That is how basic depreciation works in real estate.
What do you mean by depreciation? Doesn't depreciation mean that the property is going down in value? I thought properties appreciate in value. Can you kind of explain what that means?
That is the magic of real estate. Real estate appreciates year over year in value, but it depreciates on your tax returns according to the IRS. So it is one of the beautiful tax advantages of real estate. It's why Donald Trump paid $750 on his federal tax returns, whatever it was, 4, 5, 6 years ago. When you own massive amounts of real estate, you are constantly depreciating those assets annually on your tax returns, and you can carry that depreciation forward. So extrapolate that example from $270,000. You buy a $27 million piece of real estate. You are depreciating $1 million a year at basic depreciation. If you have cash flow of $500,000, you have a net loss of $500,000. You're carrying that loss over into the next year.
Wow. So you're saying that you buy a $27 million property, it generates $500,000 of profit that you put in your pocket.
Correct.
But you're saying that because you can depreciate $1 million, you're saying that that $500,000 that you put in your pocket is tax-free. Not only that, but you're saying an additional $500,000 of losses can be put forward to the next year. So if you make money next year, that's automatically, am I saying that right?
Correct. But you'll have depreciation from the next year as well.
Wow.
So it starts to compound.
Again, Amazing, amazing. That tells you right there, cost segregation is excellent for cash flows. So what does this mean for investors then? So if an investor is a limited partner who's investing alongside a sponsor like Proud Living.
Sure.
Now, if that investor gets cash flow from that property, do they get to participate in that, or is it only for the sponsor?
No, so depreciation and cash flow really go hand in hand in most investments. So if you are an investor and you own 2% of that property and you get 2% of the free cash, you're also going to get on your K1 2% of all the losses.
Wow. So that means the investors, even if they're limited partners, they get to participate in those tax advantages on cash flow.
Correct.
Wow. Point number 2, 1031 exchange. TJ, can you explain to us what is a 1031 exchange and how does it help us save money in taxes?
Sure. So a 1031 exchange, what that allows you to do is take your profit from one sale and push that money forward into a new asset without having to pay any tax on that money. So you have a $7 million mortgage, your property is worth $10 million, you sell it for $10 million, okay? You have a $3 million profit. You can put that $3 million now into a $15 or $20 million asset and pay no tax. You are pushing and you are deferring your taxes forward. As long as you don't take that money and you push that money forward, you pay no tax on that money when you sell.
So you're saying that the profits that you make in a real estate, you don't have to pay capital gains taxes as long as you trade into a larger property.
Correct. There's some caveats, and you have to basically take with you a minimum of your prior mortgage. So if you have a $7 million mortgage and it's a $10 million property, you can't go buy a $9 million property with a $6 million mortgage. You have to continue to either have an equal or greater amount of a new mortgage to your prior. And generally speaking, when you're using leverage, you could take that $3 million and you could probably go 5 times, right? So you're gonna get a $12 million or so mortgage on a $15 million purchase. You put down your $3 million bucks, you're into a 50% more valuable asset than what you had. It's probably a better asset. You're paying no taxes on the $3 million that you
on the
made.
gains.
Yeah.
Wow. Now, you've got into a $15 million property. 5 years later, you sell that $15 million property for a $20 million property. Do you now have to pay taxes on?
You take the $8 million and you can roll that now into a $40 million property.
Wow. What point do you have to pay the taxes then on this thing? I mean, when at some point you're saying you never have to pay capital gains taxes on any profits that you make?
When you stop deferring the tax by trading into a new asset that qualifies, you have to pay the tax. If you continue doing it, then you continue doing it.
Wow. So what about when you pass away and you pass on that property to an heir or as a legacy? What happens then? Are those people now subject to big, huge taxes because you didn't take any taxes in your lifetime, and now the people that you pass it on to, are they now subject to those taxes?
It's a little bit more of a complicated question. So, it really depends on what is the estate tax amount, right? What is the maximum amount allowed to be given and passed down without being taxed? That's something that, is really sort of changing politically. Obviously you could set up all sorts of trusts. If you put your kids into the LLC before you die, and you can gift them shares of that entity over time, so really they're the ones that now own it. There's a lot of stuff to do in that regard, but that's a much more complicated question.
Complex question, yeah. All right, point number 3, QOZs. This is one that you don't hear about as often. TJ, can you tell us what a QOZ is and why is it beneficial for real estate investors?
Qualified opportunity zones were put into practice, I want to say 3 or 4 years ago. It is a federally regulated...
Under the Trump administration.
Under the Trump administration, where certain territories were identified at a federal level, and basically those opportunity zones were created to stimulate and spark investments and to bring in investment dollars into those areas that were chosen to be in the QOZs. Ultimately what it is, you can, if you have a capital gain of any sort, you sell a stock, you sell a piece of real estate, you sell anything where you have a capital gain, you can put that money into a QOZ deal or a QOZ fund. You can defer your capital gains until 2026. And ultimately, if you own that asset for 7 years, you get a step up in basis. If you own that asset for a minimum of 10 years, you do not pay any tax on the new asset upon disposition.
Wow, that's huge.
Consult with your advisor, consult with your specialist, but that is the gist of it. It is an incredible opportunity,
wow, amazing.
No pun intended. You know, it's not going to be around forever, but it is a strike while the iron's hot sort of thing. You know, Proud Living has some deals that are in QOZs. We would have done them even if they were not in QOZs. You know, we have great basis. We have pilot programs where we get tax abatements, but you know, we are total believers in the QOZ deal and in the QOZ fund. And you know, anybody who's looking to get involved in a ground up project in a QOZ, they are certainly something to look into.
That's an amazing point there, because if you don't pay attention to what the government is offering you, you're at a severe disadvantage. The government is going to steer where their policy, they're going to make loopholes where they want things to go, where they want money to go, where they want development to happen, where they want resources to be channeled. And you have to pay attention to what the government's giving you, because if the government gives you something, it's going to be substantial, especially if it's in terms of taxes. If people don't know about it, how can you take advantage of it? So you have to stay abreast of political developments. It's an important thing. It goes hand in hand with multifamily real estate investing if you want to do it at the highest level. Now from QOZs, let's talk about a fourth and final one, and this is very powerful, is the refinancing. What does that mean, and how is that such a powerful tool for saving money on taxes?
Refis are great. Anybody who's done them knows that they're great. Refinancing a property is a way to capture equity that you have in your building while still being able to keep the building, right? So it is the opposite of a sale. You're going to increase your amount of leverage or debt, hopefully greater than the amount of your current leverage and debt. And the difference you put in your pocket. It's called a cash out refi, okay? If I owe $6 million to my lender and my asset is worth 10 million bucks, I can go get $7.5 or $8 million of fresh debt. 7.5 or 8 million comes in, 6 million goes to my current lender. I put 2.5 or $3 million in my pocket, tax-free. I don't pay taxes because it is not a profit, it is a loan. You don't pay tax on money that you owe back. Refis are an incredible tool, you know, especially when you're adding value in your real estate. Real estate goes up, real estate appreciates, and you're doubling down and you're adding value to that process. You should be refinancing, you know, every 3, 4, 5 years, you know, and putting cash in your pocket, tax-free, and then investing every single penny of that money into new real estate.
If we make $1 million as a dentist, right? If we make $1 million as a dentist, we're paying $450,000 in taxes.
At least.
If you make $1 million on a property, and this is not even making $1 million, this is not selling a property. This is taking a property that you have gained equity in, whether it's through forced depreciation by buying a mismanaged, not well-run property, adding value, renovating units, bringing the property value up, and now you can justify the value by the income that's gone up because you've made the adjustments. Now, most people think the only way to capitalize on that profit or equity that you've created is to sell. But as TJ mentioned, by refinancing, you can go and borrow money from the bank at the new value, pay off your old loan, and pocket the difference cash tax-free. If you got $1 million out of the property, tax-free, which is different from $1 million working as a dentist where you're paying half of in taxes. You're not paying any million on these taxes. And then you go and buy $4 million worth of real estate, you leverage it up, thing called compounding starts to happen. Albert Einstein said compounding is the 8th wonder of the world. And this is how real estate, the rich get richer. And he said Donald Trump didn't pay money, didn't pay taxes. Guys that invest heavily in real estate, especially multifamily, because of the depreciating concept, they don't pay taxes. If you are located in great QOZs, opportunity zones, you don't pay property taxes. If you do cost segregation analysis, and so that the income that you get from the property can also be written off as a paper loss, an accounting loss, and you put that money in your pocket tax-free. I hope this opens the eyes for a lot of people. And the take-home message for dentists, doctors, is you should take as much of your active earned income, the money you work day in, day out, blood, sweat, and tears, treating patients, and you should convert as much of that active income into passive investment, into real estate, where you can get the tax advantages, build the income tax advantaged, and build wealth tax advantaged. If you want to get average results, you do what average people do. If you want to become wealthy, you have to follow the principles that wealthy people like my friend right next to me do. All right, guys, I hope you gained a ton of value from this video. Click on the next video for more wealth building topics. See you next time.